Hey, in this video we'll talk about how to calculate pension expense. So it has 5 parts. The pension expense for the year consists of these 5 components, and we'll go into it now, each one. Probably the easiest one to understand is the service cost, which is the actuarial present value of the new benefits earned by the employees during the year. So most defined benefit contribution retirement plans have a formula, and so it's usually based on how long you worked and what was your highest salary when you worked, or what is your highest salary during your best 5 years. Essentially it might be, what was your highest 5 years of salary. We'll take the average or something like that, right? There's a formula. So essentially every year your employees work, they all work one more year, and for many of them that gets them over some sort of threshold. For example, when I'm finishing up my 20th year, I cross the 20-year threshold. That means I'm getting a larger pension benefit. You may have heard of this from someone you know. And so for the whole corporation, that 1 year with all those employees working is going to result in an increase in your pension liability. And that's just going to depend on each employee for how long they've what that extra year means for them, and any salary increases they get at that time. You won't have to calculate any of that. So, if you're given an accounting problem, usually that information will just be given to you. This is the service cost for the year. Okay, so its effect on pension expense is, of course, to increase it. That's pretty easy to understand. Your employees work, you got an expense. The other component is interest on the liability. So the interest for the period on the PBO, you may remember the PBO from the last video, projected benefit obligation. That just means the total liability for your whole pension plan. We're going to use an interest rate to accrue interest on that, like we would do for any long-term liability. A bond payable, a mortgage payable, a note payable. It's the same thing. The interest rate we're going to use is just called the settlement rate. Just has its own name, that's all. Okay, so this is going to increase your pension expense. We're going to accrue interest on it. The third component of pension expense is the return on the plan assets. So this is the increase. Well, it says increase, but obviously you can invest in things that lose money. So I don't know why it just says increase. It could be decrease, right? But okay, assume things go well. The increase in pension funds from interest, dividends, and any realized or unrealized changes in the fair value of your plan assets. So you invest in stocks and bonds, and they hopefully go up in value. Assuming they go up in value, then this can serve to lower your pension expense. It's a bit more nuanced than that, and you'll see when I get into a more complicated example. It's actually based on the expected return on the plan assets, but we'll get into that later. The point is, for now, I want you to understand that as your plan assets go up in value, that kind of offsets your pension expense, right? So even though your expected obligation is going up because your employees worked and you accrued interest, if you earned enough on the stock market and with your investments, that could totally offset it, right? You could have no pension expense. Hopefully that makes sense. The fourth component of pension expense is the amortization of prior year service costs, or PSC, it'll be abbreviated. And this is going to increase your pension expense. So there's a few ways this can happen. One is like you have an amendment to your plan. An amendment that includes provisions that are going to increase the benefits for services provided in prior years. Okay. When that happens, essentially the large corporations really argued with the FASB about this. It was a political thing. They did not want to report all of that at once. Okay, we have a new amendment to our plan. some of these guys have been working here, 30 years, and now all of a sudden we're going to count those years a lot more than we used to, which means our liability's gone up by a lot. Okay. Are we going to expense it all at once? And the corporations won, essentially. They got the FASB to say, no, you won't expense it all at once. What we do instead is we allocate the cost, the prior year service cost, of providing these retroactive benefits to pension expenses in the future. Specifically, we do it to the remaining, we allocate it to the remaining service years of the affected employees, the employees affected by this provision. And we can get into that in more detail about how that works, but conceptually, when you have this kind of amendment, you do not expense it all at once. That's the big picture. That's the long and short of it. Okay, we also have gains or losses. So when you have large gains and losses in your pension, the fair value of your plan assets goes up or down by a lot. We don't expense it all at once. Okay, what we do, we stick it in other comprehensive income, and then we slowly amortize it. It'll be expensed very slowly over time. Is that conceptually what the FASB wants? No, that is not consistent with their whole framework. Their framework is based on reporting the fair values of most assets at this point in time at the balance sheet date. But again, the major corporations won that battle. They did not want to expense things right away when they had large losses. Now, from the large corporation's point of view, from the CEO's point of view, it is a bit understandable, though. They are in the business of, for example, with GM, they're in the business of making cars. So they don't feel that changes in the fair value of their plan assets for their retirement, their pension plan, should be affecting their net income so much. It's like, hey, I'm doing a fine job running this corporation, but maybe someone over here on the investment side is not investing well and causing these huge fluctuations that shouldn't hit my net income. That's their point of view. As an investor, I don't really care who did what. I just want to know what the fair value is. So I do find it annoying that you got to dig in the footnotes of the financial statements to find this out. Okay, and that's a good place to stop.